Hello, welcome to today's lesson on indicators. Today we are going to talk about indicators, properties of indicators, and we will pick some of the most commonly used indicators in the forex market. When I say most commonly used indicators in the forex market, I'm trying to say we are going to pick some of the indicators that every beginner must know, some of the popular indicators that every beginner must know in the forex market. So we will talk about we will talk about moving averages. We will talk about the relative strength index. We will talk about the stochastic oscillator. We will talk about the Bollinger Bands. Do you get it? All these indicators contribute to picking market direction. Do you get it? So first of all, what at all is an indicator? Indicator is a tool that you apply on a chart to help you pick market direction or to contribute in determining future direction of the market. Do you get it? Forex market is all about buying and selling. It's all about buying and selling. So indicators, when you apply some indicators on the chart, it will contribute in your technical analysis. Do you get it? At least some of them will give you a clue about what will be happening in the future. Do you get it? Some of them will give you a clue about what to do. Some of them will speak to you, especially the number of people in the market, the volatility of the market. Do you get it? And also the trend of the market. Do you get it? So indicators, some of the indicators will communicate all these things to you. Okay. So first of all, as I said, we are going to pick and also without forgetting it, let me talk about this thing. Most people doesn't like using indicators. The reason is that they believe indicators lacks. When we say indicators lacks, it means they believe that they delay in giving confirmation. So due to this reason, most of FX traders doesn't like using indicators. But there are some people, they have modified these indicators in their own way, in their own preferable way, and it is helping them. Do you get it? They have modified it in their own way and it is helping them. They are using it, they are making money with it. Do you get it? So pay attention, learn how to use it. When you get the knowledge, modify it in your own way, and you can make money from it. Okay, so first of all, let's pick the moving averages. Moving average is one of the most popular averages in the forex market. It's one of the most popular indicators in the forex market, especially when you go to institutional technical analysis. You see them mentioning moving averages. You see moving averages in most of the analysis. This should tell you that moving average is one of the most popular indicators in the forex market. So moving average, let's see where we can select the indicator. So you press anywhere on your chart, you see this symbol, like the frequency symbol. I don't know, it's F sign or frequency symbol. So you press on that one. And I have no indicator on the chart because that's why here is blank. So you go to add there are some interface. You see add, here you see main window. So you press on main window, you look through and select moving averages. So this is the moving averages. Do you get it? We are going to talk about all these averages. And I'll be doing videos for them. Okay, we'll be talking about all these averages, but for now I want us to talk about the most popular one. So we are going to talk about the moving averages. Okay, so you select moving averages. Let me tell you one thing about moving averages. Moving averages, it helps you to determine future price movements of the market. And also some of the moving averages help you to determine an initial change in trend. We talk about that one. And also some of the moving averages help you to determine the overall market direction, whether in an uptrend or downtrend, whether the market is ranging, whatever. Do you get it? So right now I want us to talk about 3 moving averages. We are going to talk about 3 moving averages, and we will learn how to combine all these 3 moving averages together. We will learn how to combine all these 3 moving averages together. So we will talk about the 7 and 14, that's 1. We will talk about the 8 and 9, that's 2. We will talk about the 200 moving averages, that's 3. Do you get it? So the first one that we're going to talk about it will help you to pick entry from the market. It will tell you whether to buy or sell. That's the first moving average. It will tell you whether to buy or sell, whether to go in for buy or to go in for sell. Do you get it? And also, let me talk about the period over here. Do you get it? Let me talk about the period over here. The period over here determines the speed of the moving average. It determines the speed at which the moving average affects prices. Bear in mind, note this down. The higher the moving average, the slower its movement. The higher the period, all that I'm trying to say is the higher the period, the slower its movement, or the slower that it affects prices. The smaller the moving average, the faster its movement. So right now we are going to learn how to pick direction with moving averages. Do you get it? So there is 2 averages that work perfectly when picking direction for these moving averages. So we are going to combine 7 moving averages and 14 moving averages. So let's first select the 7 moving average. So here we'll change the period to 7. I'll change the period to 7. So I'll change it 7. I'll press on down. Let me go and edit something. When you change it to 7, change the color to red. That's my personal settings. You change the color to red. You press on down. You see that there is some red line passing through the chart. That's the 7 moving average. You get that's the 7 moving average. Look at how it's affecting price. So we are going to learn how to use it. That's the 7 moving average. You get it? That red line passing through the chart. So right now I've added the 7 moving averages. As I told you, we are going to use 7 moving average and 14 moving average at the same time. Do you get it? We are going to use them simultaneously to determine market direction. Do you get it? So for now, go through same process and select 14 moving average. So you go through same process. You press this sign, F sign, or the frequency sign. We press on main window to select new moving average. Do you get it? So instead of the 7, we will now make it 14, and we will change the color to blue. That's my personal settings. The reason why I'm changing the color to blue is that so that we can distinguish the 7 from the 14. Because if you maintain the same as red, you won't see which one is 7 and which one is 14. Okay, so when this one is red and this one is blue, at least we can know the difference. Okay, so you can see the 7 and 14 moving averages on the chart. 7 and 14 moving averages on the chart. I've added the 7 and 14 moving averages. You can see them on the chart. You get it? Very good. So right now the 7 moving average and the 14 moving average, which one moves faster? Think about it. The 7 moving average moves faster than the 14 moving average. Why? The 7 moving average moves faster than the 14 moving average because the 7 moving average, the period is smaller than the period of the 14 moving average. As I told you earlier, the smaller the period, the faster its movement. Do you get it? 7 is smaller than 14. Hence, the red moving average on my chart currently, as I have customized, the red moving average will move faster than the 14 moving average. So how then do we use it? So to use to use the 7 moving average and the 14 moving average, to use the 7 moving average and the 14 moving average, we call something golden cross. We call something golden cross. Golden cross is the technique or is the strategy that we use to trade this moving average that I've added on my chart. So what at all is golden cross? So golden cross is when the faster moving average crosses the slower moving average. When the faster moving average crosses the slower moving average, that is termed as golden cross. You see, when the faster moving average crosses the slower moving average, it is called golden cross. So here there was a cross, here there was a golden cross, golden cross, golden cross. Anytime you see a cross between the 14 and 7 moving average, it is called golden cross. So what at all are we looking at? Anytime a golden cross occurs, look at the direction of the faster one, because it affects price faster than the 14. So anytime a golden cross occurs, just look at the direction of the faster moving average. And the direction of the faster moving average means that the probability that price will move into that direction is very high. So let's say if after golden cross and the red line crosses, because always it will be the red line that will cross the blue line. Do you get it? It will be the red line that will cross the blue line because it moves faster than the blue line. So if the red line crosses the blue line, or if the 7 moving average crosses the 14 moving average and it is pointing upwards, it means the probability that price is going to buy is high. If the cross occurs and it is the red moving average crosses downwards, it means the probability that price is going to sell is high. So let's take a look at this at this point. There was a crossover here. The red one crosses the 14 moving average, which was an indication that the probability that price will rise is high and price rolls up to this point. Here there was a cross to the upside and price rose to this point. You get it? So here too, there was a cross to the upside, a cross to the downside. You get it? Indicating price will do what? Price will fall, and price fell. You get it? So always after the cross, look at the direction of the red line. If that's the direction of the fastest moving average, that's the 7 moving average. Okay. So looking at this point too, you can see that when price got here, the red moving average, that's the faster one, crosses the 14 at this point, and immediately after the cross, price rose up. You get it? Very good. So that's how we use the moving averages. So as you can see here too, red crosses the 14 moving average and price rose up. You get it? So here too, you can see that there is a cross to the upside, which is an indication that probability that price will rise up is high. You get it? So that's how we use the 7 moving average and the 14 moving average. Okay, that's how we use them, the 7 moving average and the 14 moving average. Anytime a cross occur, just look at the direction of the faster moving average, and it has a higher probability of moving in that direction. So for this one, a cross occur and the red moving average was pointing downwards. Do you get it? Thereafter price fell. Do you get it? So that's the use of the moving average. You can rehearse on it more. If you have any question, I will leave my contact. I will leave my WhatsApp number on a description page, so you can contact me if you have any question on moving averages based on what you have done so far. So let's talk about the second one. We are going to talk about the 89 moving average. So first of all, let me go and add the 89 moving average. 89 moving average is one of the moving averages that is not known by many traders. A lot of traders don't know how to use it. They don't even know how it works. Do you get it? So let me type it here. if the market, oh sorry, let me go and change the color. If the market is about to change trend, if the market is about, so the 89, my own customization, normally sometimes I make it black. Yeah, normally I make it black. Sorry. Very good. So it is the black color over here. So normally if a market is about to change trend, the first indicator that sends the trend is the 89 moving average. Whenever market is about to change trend, the first indicator that sends the trend is the 89 moving average. Do you get it? So what I'm trying to say is that the 89 moving average is the first moving average that will tell you that the market is about to change trend from either from the upward trend to the downward trend, or from the downward trend to the upward trend. You get it? So how does it work? When you see that candlesticks, when you see that the candlesticks about 4 or 5 candlesticks have crossed the 89 moving averages downwards, like this candlestick, about 3 or 4 they have broken the 89 moving averages downwards, it should tell you that price is likely to drop. Do you get it? It should tell you that price is likely to drop. So for instance, this one, or you see price was in an uptrend, or this one, and price started falling. Do you get it? Price started falling, price got here, it broke the 89 moving average, about 3 or 4 candlesticks broke the 89 moving average, and this should tell you that the uptrend has ended. And you can see that from there, price started falling from that place. So when price got here, about 3 or 4 candlesticks broke the 89 moving average, that's the black one, and from there the trend also changed to an uptrend. You see, so the 89 moving average, it will work. When 2 or 3 or 4 candlesticks break the 89 moving average, it should tell you that if the market was currently in an uptrend, it is now coming to a downtrend, or if the market currently was in a downtrend, it is now coming in an uptrend. Do you get it? So here about 3 or 4 candlesticks broke the 89 moving average and price fell. Do you get it? Price fell. Price got here, hit the 89 moving average and fell. You see, it didn't break the 89 moving average. Do you get it? It went to hit it and price fell. Do you get it? So here too, about 3 or 4 candlesticks broke the 89 moving average and price rose up. Do you get it? Price rose up before falling. Do you get it? Yeah. So that's the work of the 89 moving average. About 3 or 4 candlesticks broke the 89 moving average at this point, and price started dropping up to this level. Do you get it? About 3 or 4 candlesticks broke the 89 moving average at this point, and price started rising. Do you get it? About 3 or 4 candlesticks broke the 89 moving average at this level, and price started dropping. See the drop. Price started dropping up to this level. About 3 or 4 candlesticks broke the 89 moving average over here, and price started rising. Do you get it? So that's the work of the 89 moving average. It's the first moving average that sends trend reversal. Do you get it? So this one too, you can see that price has broken the 89 moving average. This is US oil. Price has broken the 89 moving average at this level. Do you get it? Yeah, and it should tell you that this uptrend has come to an end, and price is likely to rise at this point. Do you get it? Price is likely to rise at this point. That's the 89 that's what the 89 moving average is telling us. Okay, so let me talk about the last moving average before we switch to the other indicators. So the last moving average that I want us to talk about is the 200 moving average. So the 200 moving average, you see, the main use of the 200 moving average is to determine the trend of the chart, whether the chart is in an uptrend or the chart is in a downtrend. You get it? There is one saying in the forex market, and it goes, don't go against the trend. Do not trade against the trend. If you go and price is buying massively, don't go and trade against the trend. if you go and price is selling massively, don't go and trade against the trend. So the 200 moving average will help you to know the type of the current trend that the market is going on. Do you get it? Whether the market is in an uptrend, downtrend, or ranging market. Do you get it? So for now, let's go and add the 200 moving average. So I'll come here, period, I'll type 200. The color, I'll just come here and make it green. That's my preferred color that I use for 200 moving average. Very good. So when we are done with the 200 moving average, we will learn how to combine all the moving average that I taught you so far. You see, as a forex trader, you need to combine a lot of things to pick direction. You get it? You need not to focus on only one thing. You have to combine a lot of things to pick a direction to the market. You need not to focus on only one thing. So you have to combine a lot of things. So the green line on the chart is my 200 moving average. Do you get it? So this is how it works. When the candlesticks are above the 200 moving average, it means the market is in an uptrend. When the candlesticks, you see here, it was above, it means the market is in an uptrend. When the candlesticks are below, it means the market is in a downtrend. You get it? Here, the sticks were above, it means the market was in an uptrend. You get it? So here too, the sticks were below, so it means the market was in a downtrend. You get it? So the 200 moving average is used to determine the trend of the market. So right now, let's learn how to combine all the indicators, all the moving averages that I've taught you so far. So let's learn how to combine them. So to combine them, first of all, this is how you have to go by your analysis. First of all, check the trend of the market. Is it in an uptrend or a downtrend? So currently, the candlesticks are above. So it is the 200 moving average is telling us that the market is in an uptrend. That's what the 200 moving average is telling us. It means the market is in an uptrend. Let's come and check the 89 moving average to see what the 89 moving average is telling us. So the 200 moving average is telling us the market is in an uptrend. So we should be looking for buy opportunities. Do you get it? The 89 moving averages to about 3 or 4 candlesticks have broken the 89 moving averages. And this is an indication that price is likely to buy, or the trend is likely to be an uptrend. Do you get it? So the trend is likely to be an uptrend. It is confirming what the 200 moving average is telling us. So 200 moving averages and 89 moving averages is in line. They are in line. Do you get it? Let's come and check the 7 moving average and the 14 moving average to pick entry. We have seen that the 7 moving average has crossed the 14 moving average at this point, which is telling us that golden cross has occurred, and the red line is pointing upwards. Do you get it? The red line is above the blue line, and this is an indication that price will rise up. So you see, 200 moving average, 89 moving average, 7 and golden cross is confirming a buy. So this is a clear buy from the indicators so far. So I'll then take my buy on US oil, because 200 moving average, almost all the moving averages that I've added on the chart is telling us that price is likely to go up. 200 moving average telling us that trend is uptrend. Very good. 89 moving average telling us that price is likely to go up, or the trend is likely to be an uptrend. Do you get it? 7 moving average and 14 moving average is telling us that we should buy because golden cross has occurred and the cross is pointing upwards. Do you get it? So that's all about moving averages for now. So you can focus on it, practice on it, and you modify it into your own preferred averages so that you use it. Okay, so let's move on to our next indicator, that the relative strength index. So I'll go to my indicator window, I'll add RSI. So this one, relative strength index. So I'll press on it. Don't do any settings over here, just press on done. Okay, You see, it is below the chart. I can't see it properly, so let me go and change. Let me go and change the pixels. Let me change it to 3 here. Okay, right now I can see them. Do you get it? So this is the RSI. This is the RSI found below the chart. Do you get it? Yeah, here is it. You get it? Yeah. So the RSI is the relative strength index. It is scaled from 0 to 100. See below here, 0 to 100, 0 to 100, 0 to 100. So apart from the 0 to 100, we can see that we can see some specific calibrations in between the 0 and 100. That is 30 and 70. 30 and 70. Do you get it? So relative strength index is scaled from 0 to 100. And we have some important calibration in between 0 and 100. That's the 30 and 70. And they speak to us. The relative strength index measures the overbought region and also the oversold region in the market. So when we talk about overbought, when we say a currency pair or a commodity have been overbought, it means the buyers in the market have become exhausted. They are tired. And sellers may jump into the market soon. That's overbought. When we say oversold, it means the sellers in the market have become exhausted. They are tired. The sellers are tired. That's oversold. The sellers are tired. They have become exhausted, and buyers may jump into the market soon. So that's the difference between overbought and oversold. So in between 30, 0 and 30 is oversold region. In between 0 and 30 is oversold region. In between 70 and 100 is overbought region. In between 0 and 100 is overbought region. In between 30 and 70 at this place is called neutral region. Do you get it? It's called neutral. So when the RSI, the line of RSI, enters or break the 70, it's above 70. In between this zone, it's above 70. It means the currency pair or the commodity in quotes is overbought. It's overbought and sellers may jump in soon. When the line of RSI, this line, enters below 30, it means the commodity is oversold. Do you get it? And buyers may jump in soon. Let's see something over here. We can see that from this point, it enters the 30 region, and immediately price rolls up because it enters. When it enters, it means price is oversold, and sellers will be most of the sellers will be closing their orders very soon. Do you get it? So it was in the oversold region, and the probability that price will rise from oversold region is very high. Do you get it? And price will rise from there. Do you get it? So it means when price gets to oversold region, overbought region, price doesn't last there for long. Price was in oversold region at this point. That time the market was at this place. So when the market was at this place, the RSI line was in oversold region, which should tell you that the sellers are exhausted at this point, and the buyers will enter very soon. And from that point, you can see that the buyers jump in and they push price upwards. When price got here, the RSI line got to overbought region. It got to overbought region. You get it? And price doesn't last long in overbought region. So when price got there, price started moving from overbought region. When price was in an overbought region, it means the buyers in the market have become exhausted, and sellers may take control soon. So definitely the sellers took control. They push price down. Do you get it? where they push price down and price entered the oversold region once again. So price entered the oversold region at this point, and it should tell you that oversold region sellers are exhausted and buyers may enter or jump into the market very soon. So the buyers jump into the markets, price moved up. So price moved up from the overbought region. So oversold region, overbought region is one of the most interesting indicators in the forex market, because when you are dealing with it right now, price is neutral. Do you get it? So when price is neutral, you then wait. Immediately price enters the overbought region. When price enters overbought region, you should expect a sell, because overbought means buyers have become exhausted and sellers may jump into the market very soon. That's the indicator. Do you get it? And also the oversold region. When you see that the line has entered the oversold region, it should tell you that the sellers in the market have become exhausted and buyers may jump into the market very soon. Do you get it? So that's the RSI, the relative strength index. It's very interesting indicator. So you can learn how to combine all these indicators together to pick a direction from the market. Okay. So let me talk about the stochastic oscillator. The stochastic oscillator work like the relative strength index. Do you get it? So first of all, let me delete the relative strength in the index and add the stochastic oscillator. So let me add the stochastic oscillator. So you look through to select stochastic oscillator. So here is it, stochastic oscillator. So this one, to don't make any changes, press on done. Okay, I can't see the pixels very well. Let me go and change my pixels. Yeah, I'm going to change my pixels. Okay, I'm changing the pixels for me. Okay, so this is the stochastic oscillator. So the stochastic oscillator to determine the overbought region and oversold region of the market. You get it? So for the overbought region and oversold region, it is calibrated 80 and 20. You get it? So this should tell you that 0 to 20 is oversold region and 100 to 80 is overbought region. Since I have already explained the overbought region and oversold region RSI and how to use it, same thing apply to here. Guess that this one, the calibration is 80 and 20. So 80 to 100 is overbought, 20 to 0 to 20 is oversold region. Okay, so let's move on to our last indicators for today. Let me delete all these things so that the chart doesn't look scary. Do you get it? I don't want the chart to look scary. So we are going to talk about our last indicator, and that last indicator is Bollinger Bands. Bollinger Bands. This is one of the most interesting. I'm trying to change my pixels, so that I can see it clearly. So you see how it is. Yeah, this is the Bollinger Bands. So the Bollinger Bands, it consists of 3 bands. We have the upper band, the middle band, and the lower band. You get it? That's 3 lines. You can see some 3 lines. We call it bands. You get it? So the lower band, middle band, and the upper band. So the first use of the Bollinger Bands is that it helps us to determine the volatility of the markets. It helps us to determine the volatility of the market. So if the bands are open, it means the market is volatile. If the bands are closed, it means, like for example, if the bands are closed like this, it means at this point the market is not volatile. You get it? But if the bands are open like this, large, it tell you that at this point the market was very, very volatile. You get it? But when the bands are closed like this, it means the market wasn't volatile. You get it? Let me tell you one thing. Upper band, lower band, and middle band, they are potential reversal points. They are potential reversal bands on the Bollinger Bands. You get it? The upper band, lower band, and middle band are potential reversal bands on the lower band. You can see, like, look at something over here. You can see something. you can see that anytime price get to the lower band pushes price to the middle band, and anytime price go to the upper band pushes price to the middle band again. So you should know how to trade it by now. Do you get it? So let's say whenever you see that price get to the lower band, when price hits the lower band, you pick a buy from there. Do you get it? And set and target the middle band, because the middle band is likely to reverse price or push price up to the upper band. Do you get it? So you should target you TP at the middle band. So when price immediately price get to the lower band, you pick a buy and you take profit at the middle band. When price get to the upper band, you pick a buy and take profit at the middle band, because whenever price get to the upper band, definitely price will get to the middle band. When price get to the lower band, definitely price will get to the middle band again. Do you get it? So that's the use of the Bollinger Bands. Do you get it? So here price go to the lower band, upper band. So here when you take a sell, you take TP at the middle band. Do you get it? Yeah, because definitely price will approach that area. You get it? So here to you can see that here and the Bollinger Bands, when you were using the Bollinger Bands, we call something squeeze. We call something Bollinger squeeze. When we say Bollinger squeeze, this is an example of Bollinger squeeze. Bollinger squeeze, like the bands are close to each other. The bands are very close to each other. So when you see a squeeze like this, like the bands are close and very thin like this, what you have to do is set a buy stop 10 pips above the upper band, or 15 pips above the upper band, and set 15 pips sell stop below the upper band. And whenever the upper band or the lower band is broken, that's a clear direction to the market, and your sell stop or the buy stop will activate. Do you get it? So if you don't understand anything, my WhatsApp contact will be dropped in the description section, so you can go there, WhatsApp me, and we'll talk more. You get it? I'll explain things to you very clear. So we talk about the moving average, we talk about 7 moving average, 14 moving average, we talk about golden cross, we talk about 89 moving average, 200 moving average, RSI, and stock. I've talked about Bollinger Bands. Do you get it? So we'll see you in the next episode of these indicators.